Good evening, partners, and it's good to be back on Market Pe Charcha once again after a brief break. In fact, you know, due to our travel schedules and all that, so it's good to be back here. With me, I have our MD and CEO Dinshaw Irani. Today, you all keep meeting him, and you would have seen him, obviously, and met him in person as well. Let's begin this edition of Market Pe Charcha with previous quarters, some of the review that how the quarter has gone by, Dinshaw, and then, we will move to what's happening. We will move to the real questions, maybe once we sort of decode the previous quarter, because it's been one quarter. We had seen a lot of ups and downs in the first 3 months of this calendar year, and then in this quarter we have seen some kind of respite coming in across the board, right? But then there is something which is triggered again, so we will come to that. But first, let's decode the first quarter of this financial year for our
Okay,
viewers.
so yeah, you're talking about the March quarter, I assume, right?
Yes.
So it just shows how much time has lapsed since we had the last call. But anyway, I'm sorry about that, guys. We'll try and keep it more frequent. I think it was a travel schedule of both Devi and me, which was always clashing, and we couldn't go ahead with the call. But let me start off with the quarter gone by, which is March. Now June is getting reported, so that's why I was a bit confused. But I'll also try and cover the June quarter briefly. But let's start with the March quarter first. So basically, the narrative when the war started was that this quarter, the March quarter, will be a bad one because the war has started and consumer confidence will take a backseat, demand will go down, and so on and so forth, right? And the raw material prices will increase and we may not be able to pass on to the consumers. That was the narrative which was going around. But the March quarter surprised positively. In fact, just to give you a comparative number, the December quarter had seen an 18% growth in NSE 500 earnings. The March quarter, which was supposed to be a single-digit growth kind of a quarter, mid to high single-digit growth, turned out to be a 15% growth quarter. And that was surprising because nobody expected the NSE 500 to grow earnings at 15%. And that's what I think even the market reacted positively afterwards to that. But then if you look at the components within that 15% growth, the large cap cohorts grew at around 6%. The mid cap cohort grew at around 28%. And the small caps grew at 41%. These are earnings growth we're talking about. Why so? Because it's easier to explain the large caps than the mid and small. But for instance, large caps, the big chunk comes from IT, a big chunk comes from FMCG. IT hardly grew. It grew low single digits as such, to mid single digits. Then came the FMCG pack, low double digits to high single digits growth. Then came all these other banks, which unfortunately didn't show that exciting a growth either. So basically, the whole large cap pack didn't show exciting growth. This quarter again, by the way, we expect this to continue not only this quarter but across the year as such, the large caps. The mid and small cap, however, they showed a very exciting growth, and that was mainly because bulk of the emerging new age companies, all the exciting auto ancillaries, or for that matter, the defense plays or power plays, it's packed with those, right? Ancillaries to powers, by the way, to defense rather. They're packed with the mid and small cap segment is packed with that. And that is why the growth is so exciting out there. By the way, the growth came along with very strong balance sheets. So it's not that, as I always say, that I think the smallest of the small caps nowadays is around $1.5 billion market cap, which is during my time when I started my career, there were hardly any companies with 1 billion plus market cap. So it's a fairly decent sized company that we're talking about. Coming to the current quarter, again, the narrative is pretty bad. The narrative is that the bulk of the high cost inventories are going to hit the corporates in this quarter. They will not be able to pass on that cost hikes to consumers. Even if they do, wherever they've done, the consumers will panic and the consumption will go down. That's what the narrative is. The reality thus far, whatever the advanced numbers that we've been seeing, is otherwise. The advanced numbers are fairly strong, be it auto retail numbers, or be it even the consumer discretionary, or even the consumption led plays like Phoenix and Vishal and V2 retail. All these guys, I mean, they're basically the end consumption is through these kind of stores, right? Their numbers have been pretty exciting. And we're awaiting the final numbers to come out. I think bulk of the reporting will be done by 15th of July. All the numbers will come out by 15th of, sorry, not 15th of July, 15th of August. But bulk of the reporting will be done by end of July. So basically, we're waiting for the numbers to come out before taking a call here. But the fact is that things are not looking as bad as being made out to be. As I said, the narrative is always in a down market is always more negative than the actual reality. But here, I think it'll be again positive surprise, and I have no doubts that again the mid and small will far outperform the large caps, mainly because the mid and small suffered the most when the downturn started in the Indian economy, and they are the ones which should gain the most when the upturn starts, which has already started according to us.
So taking it forward from where you left, Dinshaw, that we've been fairly constructive on mid and small caps, right? And in fact, last, I think, if you look at the 3 months of the indexes, mid and small cap has beaten the broader index also. What do you think? I mean, what will make this outperformance sustain? Will it sustain from here? What is the ideal period which an investor should be looking at now, and while investing now? And why do you think, that mid and small caps will, because one thing which keeps coming up again and again is that large cap is cheap, right? Large cap trades at 20 times 1 year forward, and it's cheaper, right? But then as a house, we've been very, very, constructive on mid caps, right, for some time now. So what do you think are the three, four, key important points which is making us so gung-ho about the mid and small caps now? Or rather, we were the first one, to call out that in Feb of 2025, right? What do you think, will help this outperformance sustain for next year or couple of years? And what is the actual time frame which you are looking at, from your lenses?
So basically, okay, let's start about the valuations, which is much more easier to explain.
Yes.
So if I give two stocks, saying both these stocks quote at 20 P's, which one will you buy? Obviously, your next question will be that what is the growth rate within these stocks, and then you will take a call. Obviously, the higher growth rate wins over the lower growth rate, right? So that's how basically in your mind you'll start calculating PEGs. So if I tell you one stock is growing at 20%, the other one at 5, you'll obviously jump for the 20% one, because now the PEG is working out of 1 for the 20% with 20 P and 20% growth. The PEG is 1, and for the 5% growth, it's 4. 4 is more expensive than 1. So obviously, you go for that 1 PG. Same holds good for the cohorts of large, mid, and small. By the way, on a PE basis, the mid caps are the most expensive. Standalone Ps. They're at roughly around 25 times forward
Yeah,
earnings.
25 times forward.
Yeah. But then the growth rate is roughly around, say, 23 odd percent.
Yeah.
CAGR, we're talking about
Yes.
the mid cap cohort. And I'm not even talking about the 30 odd stocks in the 150 universe, which quote at P's of 17, 80, right? So we clubbing them together. We clubbing them, if you remove them, obviously the P's will come off. But we clubbing them together. And despite them, the high P stocks still being there, the PG works out to 1.1, right? Which is okay, which is not as expensive as is made out to be. Then comes the second most expensive cohort, which is the small caps. They're quoting at P's of 21 time forward earnings. But the growth rate out here is 23%. So the PEG now works out to 0.9, right? Less than 1, which is a very exciting number to look at. Now let's come to the cheapest cohort, which is large caps. They're quoting at some 16.7 or 17, I think now 17.2, 17.3 times forward earnings. But then look at the growth rate out here, it's 10%. Now the PEG is 1.7. So which is the most expensive? Is the large caps, right? So that's how we're looking at it that way. And that's why we called it out earlier when we in fact brought out our mid cap fund and then our small cap. The PEGs were much, much lower than what they are today. And that's why we call them out. But even before if I, you ask me about the why we are turning so bullish on
Yeah,
these
yeah,
now, because the PEGs have always been very exciting. But let me share the graph with you for this one.
the PG as
Yeah,
a indicator.
yeah.
Yes.
Here's the graph that I want to share with you. This is basically it's not too complicated. The graph looks complicated, but it's not. So okay, so basically what we've done here is we've taken the mid cap index, 12-month rolling return of the mid cap index, and deducted the 12-month rolling return of the large cap index. Basically, this line graph shows you, and this is not from like today. It's actually starts from 1st of April 2004. So it's a 22-year graph of the outperformance of mid cap index over the large cap index. Anything above the zero line means the mid cap is outperforming. Anything below it is underperforming. And the green dotted line, the dash line that you see, is basically the average outperformance of the mid cap over the large cap index, which is roughly around 6.5%. Right. Let's go to the mid cap, small cap line graph. Here again, you can see that the small cap, this is again the same calculation, the rolling 1 year return of the small cap index minus the rolling 1 year return of the large cap index. Now, here the average outperformance is close to 10% of the small cap over the large cap over a period of 22 years. Yeah. What you do notice, and I'll keep it out here because both the graphs look similar, so I'll just keep it here. This is a much more finer line that has been drawn. Now, if you notice, normally this graph, whenever the outperformance stops, comes and takes a stop at the blue line and then moves up to the red line, right? And then comes off again, down back to the blue line, right?
Yeah.
It happened some 7-8 times in the past 22
Usually
years.
the one standard deviation, both side. Yeah.
Yeah, yeah. So only once has it broken the blue line and gone to the dark red. I mean, the -2 standard deviation line, which is down below. But
Yeah.
that was only in 2006, when, if you remember, the large cap index far outperformed. It was up some 45 odd percent, and that's why that performance. So it wasn't a negative return, but it didn't perform in line with the large cap. So that's what it was. Yeah. The blue line is -1 standard deviation. If you notice, it's close, it stops at something like minus 22, 23%. That's where the blue line stops at. The red line is +1 standard deviation, and that is roughly around 37, 38% beyond the mean return, right? If the index moves from the blue line to the red line, means it's almost doubling in absolute terms. This normal move happens between 12 to 18 months. That's how it works, right? In the case of the mid cap index, though you can see the support level at Jan levels and in Jan, but it's actually in Feb. And for the small cap, it happened in March, right? And the turnaround has started again. There was some breather because of the war restarting again, but it's conclusively beaten the outperformance. Now, I'm not saying that the index will double in 12 to 18 months. What I'm trying to show you is that the outperformance over the large cap has been established, and we expect this outperformance. And as I said, that the way down it takes another 12 months roughly. So we expect this outperformance to continue for at least 2 to 2.5 years from here on before the turn happens. And as you're aware, Devi, and we've done this together. We started an emerging star PMS, actually looking at the graphs in March itself. And the AIF we are starting now because we took a while
Yes.
for the approvals to come through. But we're
Yeah.
starting an emerging star AIF, which is going to be a pure mid and small cap AIF.
Yeah.
So that is how it is. And yeah, now actually, let me share bit more, a few more. So when people say that, look, maybe the outperformance is misleading you, but here's the 5 year rolling returns for the mid cap index and the small cap index. We are somewhere close to the average. We're not even gone beyond the average as such. We come down and we're touching the average as such. So I think we are in a very safe zone where we can play this easily as such. So that way.
So, I'm sure, fair enough. There has been estimates, so current, if you look at the current EPS of Nifty would be, 1,148 bucks, right? Roughly around that. And even if you put a rough estimate of, 6.5% growth, 4.5%, 4.5% kind of inflation for next 2 years, that would work out somewhere around, say 1,300, 400 rupees, right? On the EPS side. And if you look at from that perspective, we trade at about 16, 17 times, to FY 28, right?
Yeah.
You are also of the camp that we will be able to sustain this kind of, I mean, we will be able to get this kind of earning growth, plus we'll be able to sustain. What are the worries, from the inflation side, right? All of a sudden, last month we had a scare of a rate hike, and then we were staring at inflation numbers inching up, and we were looking at that, okay, if the oil doesn't settle or this geopolitical tension doesn't settle, then it's gonna trouble us, right, with a quick rate hike to curb, or sort of control the currency fluctuations also. And then, but then, talk to us, the steps which the government and the central bank has taken, right, in terms of FCNR bonds and all that. What do you see? I mean, how do you see that benefiting us? Is the number one thing, and then the sustainability of these earning, that where do you see this earning coming in from in the large cap space also? Because large cap, there is financials, there are various other pockets of it, right? One of the pocket we are not into right now, which is going under a disruption. So which are the other pockets, even if say the 16% kind of a growth gonna come at a Nifty level, where do you see that coming in from? And then how these recent changes and reason, are gonna benefit us?
So basically, the interest rate hike, that was the scare that was being talked
Yeah,
about, was basically brought upon the RBI because of the way the currency, the INR, was behaving vis-a-vis the
yeah,
dollar. We went through as high as almost touching 98, 99 to the dollar, and that was a worrisome uh, call for the RBI. There are only two options: either to dump dollars, go short on dollars, and try to support the rupee, or basically take an interest rate hike, make rupee look very attractive. But they took a very bold step. The last time ever we did that was in 13, when Raghuram Rajan was worried about the rupee, and I think it had gone from 60 to 66 in a very short while, and he was worried about the rupee going down further, and he took that step that, look, I want to attract FCNRBs from my NRIs who know exactly what is happening in India, and they will support, and that's why he went aggressive and told the banks to start raising and give leverage and stuff like that. Yeah, that is the exact step they did. Yeah. And yeah, so basically that supported the rupee to an extent. However, unfortunately, uh, we were initially expecting 50, $60 billion to come in, but looks as if it's gone off with a tepid start. Why? Because the sovereign overnight funding rate, so far as they're called, uh, normally the international banks lend to the Indian banks based on that rate, and plus they charge some 30, 40 bips higher. The international banks realize that the domestic banks are going to raise a lot of money. That's why they've upped the SOFR plus rate as such, and as a result, the Indian banks are not able to give the NRIs that kind of a interesting margin in their lending per se, in the leverage part. So maybe it'll take a while for things to cool off before the real number comes out. But anyway, it was a big step for by the government, and I think we'll raise maybe not 60, probably around 40, 50, but that's also a decent number to look at. Last time around, we raised $27 billion. That was in 2013. And if we even raise 50 odd $billion now, it should be a very good number to look at. Yeah, gives a lot of breather to the currency per se, and plus cooling of the oil prices again gave a lot of breather to the currency. So I don't think RBI is under pressure. Inflation, if at all, if it comes by, I think it'll come by probably by the end of this particular year. And only then will you see the RBI getting worried of the interest rate. So maybe the interest rate hikes also won't happen in a rush. Yeah. Because RBI also wants the country to have a run, consumption run as such. So that way. So that's why I don't think the interest rate hikes will happen. They could have happened, but as I said, that RBI was very clear, or rather, the government of India also was very clear that we need this nascent consumption growth to continue and establish itself before taking a hike in interest rate. So that was one. In terms of the growth rates, I am not in the camp which believes that the narrow index, which is the Nifty 50, will grow at whatever 15, 16, 17%. I don't think that's going to happen. The broader index may do it because of the cohort of the mid and small cap. But the larger index, the narrow index, which is Nifty 50, I don't think, or the Nifty large cap 100, may not be that exciting. If you've seen Nifty 50's growth for March was in single digits, mid single digits or so for the full year, right? I think it was 7 odd percent, 7, 8% or so. So maybe the base may catch on. Maybe they'll show some low double digit kind of growth. But as I stated, that the problem with Nifty 50 is that it's stuck with these companies which are low growth companies, IT pack, for instance, FMCG pack, again, another case in point. Commodities, for that matter, always a choppy pack. Banks, again, zero sum game being played out there. If PSUs gain, the private sector loses. Private sector gain, the PSU loses. So that's how it'll work out. So that's why it's not looking that exciting. But the good part is the Nifty 500 will continue to show the growth that we've been talking about, because we think that's more reflective of the GDP. If your real GDP growth is 10.5, 11 odd percent, they should add 2-3% to that growth and show you that kind of growth, because in NSE 500 doesn't have any agri stocks. Agri is the portion of the GDP which pulls the GDP down, because it always grows less than the GDP. So that's the thing out here. But having said that, one more thing I want to add out here for the earnings growth bit is, it's unfortunate that the large caps are not going to grow at this level, because if that happens, the passive funds, the passive FPIs, which is mainly all those funds which track global ETFs, I mean the ETF money which comes to India, that may not be that excited about India. So that's why big money coming to India, unfortunately ETFs are big money. I think more than 2/3 of flows in India are ETF driven, only 1/3 is active driven as such. So if that happens, then obviously you won't see the big money coming into India, because they will just say that nothing is happening in India, because the index that they track is not moving, right? And that is the unfortunate part. So we will not be able to, with our performance, we will not be able to hurt them by not being in India. So that is the thing. One thing I want to add out here, despite all the apprehensions, June was a good month in terms of performance, because every other market was down and India was the only market which was up. And that's why we outperformed not only the region, we also outperformed the world and the emerging world as such. So that was the first month when we saw some outperformance. I hope it continues. Maybe that is when these guys will get up and say, okay, something's happening here. Let's go back and check. So that way.
So there's a question which is, mid caps are at all-time high and small caps are very near it. How is that justified with all the global negatives? Are the earnings high enough to justify the valuation? We just spoke about it, by the way, but yeah, and we have shown you the chart also that it's optically high. But realistically, with earnings growth, if you reverse it, inverse it, and see with, in correlation with the PE, then, it doesn't seem that high. But then, your bit, if you want to add
So the
anything to that.
unfortunate part is that I mean, if you had seen NSE 500, should have been at a high also. But the unfortunate part is that two-thirds of the index is commanded by large caps, where there's no growth happening. So that's why you're not seeing that. Though wherever growth is being honored, that's a good part. And by the way, we've always said that the smart money always moves to growth, right? And even in the case of APIs, I mean, they've been dumping the large caps, the active ones, by the way, they've been dumping the large caps and getting into the mid and small caps because that's where they see growth. And that is why that index has done what it has done. So it's not that it's happened because of domestic flows. Even the FPIs have been effectively upping their stake in those companies. I mean, you've seen that in the case of Eternal, you've seen that in the case of Paytm, uh, G, Venova, whatever. I mean, there's so many companies where it's happened. So that way.
So in short, with, so we've been talking about mid and small cap, but, apparently we hold large cap, and, for the benefit of our, viewers and, our partners, let me put this question in a very different way. Are we investing in yesterday's India, or are we trying to invest in the India which is getting created, right? I think, large caps have been often, people misunderstand that large caps are the traditional economy stocks, but there are many large caps which is there, and we hold that those in part of our portfolios also. I think there's a question around that. If you could just, share your views on that part, would be helpful for our partners to
So
understand.
as I said that there are pockets within large caps, and unfortunately there are big weights in the index which are dragging the overall performance down. But there are exciting stocks too. I mean, there are stocks which are there in a portfolio. You can see it. Eternal, Paytm, all these guys are large caps, right? And they are doing very well. In fact, certain other large caps like Polycab and all these guys also have done fairly well, which are not owned by us, but we've been looking at them quite closely. But the fact is that we haven't got them in our portfolio. But the point is that there are good stocks which are growing faster in the large cap space too. But unfortunately, it's very limited. And that's why the mid and small, as I said, the new age India, which is doing very well, and that thanks to the way our government implemented the Jandan Aadhaar and mobile trinity, mobile as in the data, the cheap data that is available to Indians. I think that has done wonders for these new cohort of companies which are coming by, the new age companies that are coming by. And fortunately for us, you see a lot of them in the mid and small cap space. You hardly see any in the large cap space, but the mid and small caps are full of them. And as I always say that, fortunately, both the mid and small caps, it's a very dynamic group. You see a lot of micro caps coming into mid caps. And normally, when you notice micro caps coming into small caps and small caps moving into my mid caps, and obviously mid caps make it to large caps. But if you normally track this, you will notice that there's a reason why some particular group of small caps make it to micro caps, make it to mid caps, small caps, and small caps make it to mid caps. You invariably find these are new age companies because the growth rate is much higher out there, and people are appreciating that growth. The investors are appreciating that growth, and they're picking up, and obviously they're growing along with that. So that way, so that's where we're coming from. In fact, one more thing. I mean, we're so excited that we're going to launch a new age AIF as such, which is going to invest only in new age companies. So that way, obviously, there'll be a big part of our even the emerging star AIF that we launched already. There'll be a big part there, but that one will be pure new age. So that way, so I think that's where the excitement is, and that's where the money will be. As I said, the liquidity is called liquidity for a reason because it's very fluid. The flow of money is very fluid. It always goes towards growth, and growth is where the excitement is. irrespective of valuations. The FPIs have been chasing it. They've been selling low PE stocks and buying high PE stocks because of the growth, because they've seen the low PE stocks growth vanish, and they're getting into high PE names where they see growth. I'm not saying that you buy at any value, any price, the BAP theory. And fortunately for us, that is negated for us by our philosophy, which is elimination investing, where we buy only stocks with growth and quality built in, but at a value. So that is what has helped us show that level of outperformance also in most of our uh, mutual funds and most of our mutual schemes, rather, and most of our PMSs and AIFs.
Then sure, for so what's your so we have a portion of our flexi cap invested in large cap, right? Let's decode that for the partners, that why do we have that 58% of, and where is that invested, and followed by our sectoral views, especially on the financials, which we've been having for some times.
So, okay, so basically, that 58% has come down from 69%.
Yeah.
If you seen the portfolio a couple of months back, it was almost 69% large caps, which has come down to 58% large caps now. You must have seen a lot of trimming happening in the large cap space. We've Whatever we've retained in the large cap space is mainly the exciting stocks. Uh, that's where we see growth. But I'm not holding out on that also. Large cap, as I said, that as a cohort, they may not be growing that much, but beyond the Nifty 50, there are quite a few exciting names which are there in the next Nifty 50, which we are having in our portfolio, most of them. So that's where it is. And in terms of the sectoral classification, BFSI continues to be our number one position, because, as I said, that normally I expect India to do what probably a US did in the 60s, or Japan did in the 80s, or say China did in 2000s, right? And if you see the two sectors that did phenomenally well in these times, was basically consumption, which is discretionary, and was BFSI, which was also consumer facing BFSI. And that's why we like private sector banks. It's not that we have any problems against the public sector banks, but we like the private sector because they're consumer facing banks per se, and very nimble footed. So that's why we are into that. We've done some re adjustment there also. We've trimmed some names in the banking portfolio and moved to the financial services portfolio, because we believe that with per capita moving up, there'll be a lot of rich people coming, and they'll be looking at a lot of doing a lot of market activity, wealth creation, and stuff like that. So you've seen a lot of marketplace, direct plays that we are picking up. We're picking up wealth managers. We're picking up new age brokers, AMC companies, because these are the gatekeepers to wealth. And that's what we like about them. And that's where we are sticking our neck out to. In the consumption space, it's mainly discretionary. And that again is, there's a lot. It's a very diversified pack. We even consider healthcare as consumers, because as the wealth creation happens, people look at quality healthcare, and that's where this is coming from. So that is a portion of our portfolio. Tourism is a part of our portfolio. Aviation is a part of our portfolio. So that's in comes in consumption, hospitality, and so on and so forth. So that's where it is. Big packs itself account for over a third of our 2/3 of our portfolio. The rest is a mix of industrials, mix of PLI plays and stuff like that. Defense also comes in here, and so on and so forth.
So Dinshaw, one question which is there, which we've been, in fact, thinking will happen, and it's been like getting prolonged for some time now, which is private capex, right? Government has been spending, but I think we are yet to see a serious, with the credit growth being at about 17 odd percent, now. What's your take on the private capex as a theme?
So I think it has just taken off. So till now, it was the government capex just holding up. But as I said, that demand has been fairly buoyant. And normally the capex starts when the utilization levels cross 65, 70 odd percent. We're already there. And I have no doubt in my mind that the private sector capex has to pick up. By the way, even last year, it wasn't that bad. It was far higher than the government capex, but normally you're looking at like a couple of percentages points higher than the government capex. But you need to get the private capex in place, because what whenever the private capex happens, it happens on productive assets, not the logistical assets, which a government capex happens on. The productive assets give rise to a lot of. It's a multiplier effect for employment. For instance, suppose a private sector company sets up an auto plant. The auto plant alone will employ people, but imagine the amount of ancillaries that come around an auto plant. There'll be a tire plant, there'll be a body plant, there'll be a fabrication plant, there'll be a paint shop and stuff like that. And this is what gives that ecosystem the growth in employment, which is what India needs. So that's why I have no doubt that private sector capex will kick in. Obviously, there'll be a lot of new industries will come by in terms of capex. Is like, for instance, the government is talking about data centers per se. That also should add to that capex boost per se.
There's a question on Dinshaw, the way we diversify in terms of our number of holdings. So, there's a question which is that our view on that diversification. I think, we have always time and again, explained this, that, we like diversification. We believe that no one stock should, decide our, portfolio return, right? So we have always believed in that. But I think the question is on the number of stocks. I think the weightages have been, fairly diluted. So, your view on that, Dinshaw,
No,
especially on
so
the small and
basically,
mid cap side. Yeah.
so yeah, I assumed as much. It must be small and mid cap. I think the investor should be happy if he sees a regular churn in his portfolio. If he sees the mutual fund investor, that is, should be happy, because what is happening is the manager is taking a very proactive call on what looks overpriced and what is looking more attractive, right? And that's why that churn and diversification. Fortunately, in the small cap space, there's enough and more to invest in. So we are always very greedy when it comes to stocks, and we wherever we see growth, we invest. I don't know how many of you have noticed. At the end of May, our top two holdings were microcaps, and those two top holdings were in the 50th percentile level in the June end portfolio, or even down to the last quartile. So that's proactiveness. And that is what probably sets us apart in terms of nimble footedness in cashing out on returns. In my flexi cap, I think the power transmission plays at the end of May were around 12% weight. At the end of June, they've reduced down to 4.5% or so. I don't know the exact figure, but that's how it is. That again is, and you've seen what happened to them in July when the government came down heavily on, not heavily, rather than when they allowed the Chinese manufacturers to come into play. So this is what should be looked out for. We're not lazy managers. We don't go and buy a stock just because it's cheap. We do a lot of digging. We don't depend on history to decide whether we want to buy. I mean, as in historically, the stocks may have quoted at 17, 18 times, but today they quote at 12, 13 and people get excited. I'm basically talking about the IT sector. Things have changed from what it was in the past. The whole revenue model has changed. So we don't do all this. We go down to the basics. We don't go down to the way the business is done, and then accordingly take a call on the stock. So that's how it is. And I have no doubt that my managers will keep finding, my analysts rather will keep finding new names, and we'll have to compensate somewhere. We'll have to move some stocks down, trim some stocks, or get out of some stocks and buy new ones as such. So that's what's going to happen regularly. So that way.
Some quick questions. So number one, what do you feel investors should do? Lump sum or staggered, or anyways, SIP is a thing which people should continue, but lump sum or stagger STPs, and if
So
it's STPs for
STP actually, Devi is a. I don't know. I'm not a believer of STP. I mean, if you look at the longer period charts of any stock or any mutual fund or any market, even if your call is right, you're just talking about a small notch in the whole scheme of things because the graph will be like this, right? Uh, I don't know how much comfort the client also has to do STP because the moment you tell him, okay, we'll stagger your investments over, say, a period of 5 months or something, the month there's a big correction, the client himself will tell you, no, hang on, there's a big correction, we'll wait for some more and go away from that, right? And if there is not, if there's a sharp up move, he'll tell you to wait. So I'm not a believer of STP. Coming to the mid and small cap segments, I think right now is the time to do a lump sum. Because as I showed to you, normally the outperformance lasts for around 2 years to 2.5 years. So now is the time to do a lump sum for mid and small caps. You can take a call on your STPs, but as I said, I'm not a big believer of STP anyways.
Okay. Your view on, our outperformance vis-a-vis other markets, including US, do you think that from here, the tide is changing? Maybe, we have much to offer to the world and, and I think India will, or India will outperform. Do you think that?
So I am hoping that India will outperform. Frankly, I mean, looking at the way the world. So basically, if you look at the emerging markets, there are four major markets in the emerging region. There's Taiwan, there's South Korea, there's China, and then India. Right? Taiwan and South Korea, fortunately for us, they are. I mean, unfortunately, earlier now today, fortunately, they are AI driven. AI driven in the sense that they've got these three companies, two in Korea and one in Taiwan, TSMC in Taiwan and Samsung and SK Hynix in Korea, which are semiconductor plays, right? Uh, by the way, Samsung declared phenomenal numbers. Their one quarter profit was equal to the whole year last year's profits,
Yeah.
right? Some 89 trillion won or something. And the stock corrected. They went down 9% on that day when they declared the numbers. Why? Because obviously, I think there also they realized that these are commodity plays. They are, though they call themselves as AI driven, but they're actually commodities. Semiconductors are commodities. They're not brand owners.
Yeah.
They're not designers. They design. They are just printing chips based on what Nvidia gives them. The design Nvidia gives. Nvidia is the IP holder. So that's how it is, and that's why they quote at P's of 5 and 6, despite being such heavy names. The moment some excess capacities come up, and they will. I was told that next calendar year, by the end of next calendar year, there are quite a few capacities coming on stream. So you'll see a lot of correction there. So Taiwan, Korea don't look that hot. By the way, one may wonder why only three companies matter. They do because in Korea, these two companies account for over 50% of the weight. In Taiwan, that one company, TSMC, accounts for over 60% of the weight. So obviously, they do matter out there. Coming to China, unfortunately, China is having its own set of problems. Though it's a very technologically savvy country now, but the problem with China is the real estate bust that happened. The unemployment rates are running amok. I think too much of technology also doesn't help because you end up making factories which are dark factories where no workers are employed. It's all automated, all driven by robots. So that is what hurting China. So maybe China is also not looking that good. India is the only country, according to me, in this emerging space which is looking fairly healthy. So that's why my bet will be on India going forward.
Your view on, so there is your view on metals, financial services, and infrastructure.
Metals, financial services, and infrastructure.
And
So metals.
infrastructure, yeah.
Okay, so metals, basically financial services. I've told you I'm very bullish, especially the consumer-facing financial services. That's where my bullishness comes from. In metals, China is a big force to reckon with. For instance, in the steel segment, China's capacity and the world put together is equal, right? More or less same, both of them. So that's where the problem is. The day China wakes up and says, "Look, I have suffered enough. I want to now access global markets, and I'm going to dump steel in the global markets. Be dead in the water," right? So that is where my concern is. Anyway, all commodities, forget metals, all commodities, there's always a cyclical play playing out. Um, In case of non-ferrous, at least there's some support. In the sense, all the new age technologies need non-ferrous metals, right? Copper and stuff like that. So maybe that is where the support is. Even China is not that big in copper. It is big in the sense one third, but not like steel where it's 50%. But that's where the comfort is. In terms of which was the third one, financial services, metals, and which was the third one?
Infrastructure.
Infrastructure again is a very diversified play. Depends on which infra we're talking about. We're not too comfortable with those dealing with the government or the state governments. Those infra plays which deal with the state government and the central government. We're not too comfortable with those, but rest all should do well given the capex cycle of the country. But
Uh,
unfortunately, we won't find many in that space.
so inflation, crude, I think we spoke about, at the beginning only. So Dinshaw, quick question. One sector which you are optimistic about?
Oh yes, so basically it's new age companies. Very optimistic. I think, as I said, that the exponential growth will happen in that particular space. Though they may be commanding exponential valuations, but the growth too will be exponential, and that is what is exciting me about that space.
And one sector where expectations are way too high.
I think it's IT, though the expectations are in mid single digits, but I still believe that also seems very optimistic. Right now, they're earning because of the depreciation of the rupee. That is why they're looking that clocking in those mid single digit kind of growths. But going forward, AI is going to be a big dampener for IT. There's a lot of questions which will be raised by AI for IT. Don't forget that 1 year back, these same companies who are now saying that AI is proving to be a problem used to always say that AI is going to assist us and it's going to open up the markets for us and stuff like that. I think it's a big corporate governance issue. I don't know whether they were misleading or they were not aware, but the fact is that that wasn't the right way to go about. So that's my view, anyway. So.
Then so 5 years down the line, so we are in 2026, 5 year down the line, if investors will look back, what do you think that, if they don't invest now, how would they should be reacting? I mean, what would they feel?
Well, I think they'll definitely be not happy investors if they hadn't if 5 years down the line they go back and see that, oh God, we had the chance of investing in Helios mid cap fund and Helios small cap fund and the Helios emerging
As
star
well.
AIF and our flexi cap and stuff. They'll really be cursing themselves. So that way. But anyway, as I said, that 5 years is a long time. But our
Yes.
belief is. Things should look pretty buoyant for India because I think the age of consumption is caught on. Uh, the blip was this war, and once this stabilizes, I think things will be on even keel. So in that way.
Fair enough, Dinshaw. Thank you very much for your insights and for wonderful chatting with you once again. We will again come next month same time with more inputs on the markets. Till then, it will be available on YouTube also, just in case you would want to go back and see in next 3-4 days time. It will be uploaded on YouTube as well. So follow us on YouTube and on Twitter. We are there everywhere. You will keep getting a lot of content from our house. And till then, stay safe and enjoy range. Thank you very much for your time this evening, ladies and gentlemen. Thanks.
Thank you, everybody, for taking out the time.
म्यूचुअल फंड निवेश बाजार के जोखिमों के अधीन है। योजना से जुड़े सभी दस्तावेजों को ध्यान से पढ़ें।